So this chapter, guys, excuse me, slideshow, is chapter 2. This chapter and chapter 3 are going to be the toughest chapters in this book. Yes?
I think they were wrong because the ones you had us take a picture of, there were different numbers on the quiz, so you had to like calculate it differently.
The quiz or the homework?
The homework.
Okay. I'm going to look and see why, because I usually try to keep them exactly the same so they're not, what do you call, that they're all the same. Everyone's doing the same. So I'm sorry, I must have screwed something up. Imagine.
I didn't have any other issues other than that one question.
Okay. I'm sorry. Hopefully we'll get it right this time. This chapter, guys, hang in there with me. If you ever need to post questions to the discussion, meet with Stuart, email me. It's these next 2 weeks. Just like you guys are doing, asking questions, just keep asking them. Okay? I'm going to go slow. So, guys, if I get behind, I need to have at least 5 minutes to give you the questions and go through the quiz, so you have that. So if you see I'm getting close to time, I try to be observant, but, stop me, okay? In accounting, we have something called the accounting cycle. And we're going to spend the next 2 chapters going through this accounting cycle process that we will complete every year. What we are learning about with last week is in financial accounting, we are going to measure business transactions. We're going to analyze them. We're going to talk about it. We're going to figure out, what is it? Is it an asset? Is it a liability? Is it a stockholder's equity? Is it going up? Is it going down? And then we're going to put those in the form of financial statements so we can communicate the activities of a company to the end user. So how do we go about measuring these transactions? Well, we're going to use what we call source documents to look and see what's happening, what's going on. So we're going to have some type of paperwork outside of the company that proves what we are trying to analyze and measure. We're going to look at the impact of the accounting equation. We're going to see, is this an asset? Is this a liability? Is this owner's equity? Then we're going to learn something new this week called debits and credits. Just so you know, a debit only means left and a credit only means right. We'll talk about that. Then we're going to record this transaction in a journal. We're going to post it to what we call the general ledger, and then we prepare a trial balance. Now, guys, when I started doing accounting back in '82, the first job I had after college, I literally had to do all this by hand. But fortunately, we have software. I did have Excel back then, but it was called something else. It was an Apple product, and I can't even remember what it was called. What? AOL's the internet. But I'll remember. But it was just like Excel, which was really helpful to not make adding mistakes. Now, how do we measure transactions? We're going to find a source document this derives from. We're going to say, okay, how's this affecting the accounting equation? And then we're going to talk about, is it a debit or a credit, which we'll look at. And then we'll record it, we'll post it, and we'll prepare something called a trial balance. So an account is a summary of all transactions related to one specific item over a period of time. Examples of accounts. There are certain accounts that are just assets. Remember, an asset is a resource. We have cash, that is an asset. We have supplies, that is an asset. We have equipment. We have buildings. We have automobiles. These are all assets, resources for a company that will provide a benefit now and in the future. We also have accounts that are liabilities, amounts we owe to people. When we borrow money from a bank, we get a benefit today, money from a bank, that's going to require us to make a future sacrifice, which means we owe it back. Got it? We're going to have to pay money because we owe it back. Or what if we have an employee that's worked for us and we owe them a salary? Whenever the word payable is after it, that means we owe somebody something. Usually a liability account will have the word payable, except there is one account we're going to learn about today that doesn't have the word payable after it, but is a liability. Then there's stockholder equity accounts. The stockholders' equity accounts are two types of accounts: common stock and retained earnings. Common stock are those individuals who have invested into our company that have given us money in exchange for ownership of the company. Retained earnings are all of the net income minus dividends paid, received by the company since it began. These are all accounts, okay? A chart of accounts is a list of all account names used to record transactions. So if you think about it, a chart of accounts for Target is going to be different than the chart of accounts for Anoka Ramsey because it's a unique business, and they are only going to use accounts that are associated with the type of business they run. Got it? So, we are going to look at analyzing transactions, external transactions, and every single transaction that we look at is going to affect the accounting equation. Each transaction is going to have some effect on this accounting equation. It will always balance once we're done analyzing the transaction. Remember, assets are resources. Liabilities are what we owe people, and stockholders' equity are those owners' claims to those resources, those that are invested in the company. If total assets increase with a transaction, then either liabilities or stockholders' equity will also increase by the same amount. If assets decrease with the transaction, then we know liabilities and stockholders' equity will also decrease by the same amount. So let's ask ourselves, when we go through these questions, we're going to sit and go, okay, what's an account that's been affected by this event? And does that account increase or decrease? And then we'll think of another account that was affected. And did that increase or decrease? No matter what, assets will always equal liabilities plus stockholders' equity. So we are going to go through all of these different transactions. These are external transactions that were a part of this company. The first transaction is that we sold shares of common stock for $200,000 to obtain the funds necessary to start this business. So let's just think, okay, Eagle Soccer Academy needed investors. Someone came out and said, I'll buy stock in your company. And they gave us $200,000, and we in turn gave them a stock certificate that says you own $200,000 in this company. Think of one account that was affected by doing this. Anyone? You can just call out. Stockholders' equity, what happened to it? It increased. What else happened, guys? Cash increased, didn't it? Right? When we sold or issued shares of stock, didn't they give us money in exchange for that stock? So didn't our cash go up? Our cash increased by $200,000, didn't it? And common stock, stockholders' equity, common stock also increased by $200,000, didn't it? So do you see our cash, which is an asset, went up $200,000, and our stockholders' equity section under common stock went up by $200,000. Do our assets equal liabilities plus stockholders' equity? See, they do. After that transaction, are we in balance? Yes, we're in balance. Does that make sense? Okay. What would have been the external paperwork? We would have received a check of $200,000. Wouldn't that have been an external document? And we in turn would have exchanged that for common stock certificate for $200,000. Does that make sense? Now, it's sometimes tempting to decrease cash as a way of recording an investor's initial investment. But remember, we are the company's, we're doing it from the company's perspective, not the individual investor. Okay? We're thinking of the accounting for the company. And so the company received cash from the stockholder, which increased our cash. Make sense? Now, we borrow $100,000 from a local bank, and we sign a note promising to repay the full amount of the debt in 3 years. What happened, guys? When we borrow money, what do we get? Money. We get money. But what do we owe? We owe money. So didn't our cash go up $100,000? But don't we now have a liability? This note's payable. Remember, liability has the word payable after it, right? Don't we owe the bank $100,000? Right? So the money we got is an asset. The money we owe is a liability. But do we balance still? Don't our assets now equal $300,000? Our liabilities are at $100,000. Our stockholders' equities at $200,000. Do we balance? Okay. After each transaction, the accounting equation must always remain in balance. Assets must always equal liabilities plus stockholders' equity. Okay, this, I don't mean for it to be tricky, but you'll understand what's going to happen here. We purchased equipment necessary for giving soccer training. We used $120,000 in cash to buy equipment. So what happened to our cash? It went down. But what happened to equipment? It went up. But do we still balance? So guys, in this example, Our assets, one asset went up, one asset went down. But we're still in balance, aren't we? It didn't necessarily affect both sides of the equation, but we're still in balance. Okay? So we basically exchanged cash for equipment. Right? Got it? It's sometimes tempting to decrease cash as a way, oh, sorry, I already did that one. What would be the effect on total assets if a company purchased land for $200,000 cash? Zero effect. One goes up, one goes down. The effect is no change. Does that make sense? After each transaction, the accounting equation will always remain in balance. Okay, now this is something new called prepaid rent. When we pay 1 year of rent in advance, $60,000 or $5,000 a month, that $60,000 is what we call an asset. Why? Because we have paid rent up front for 1 year. So we have a benefit that will provide we have a resource that will provide a benefit for us over the year. Since we paid it all up front, we write off the expense of rent expense as the rent passes with time. So prepaid rent, paying a year's worth of rent up front, is an asset. It's the same as prepaid insurance. If you pay insurance for 5 years and it's going to last you for 5 years, you write off the insurance as it's come due, as it's been used up. Does that make sense? So in this case, we paid 1 year of rent in advance for $60,000. What is one asset that was affected? Cash went down, but our asset, this new asset we're learning about called prepaid rent, increased. But do we still balance? We do. We still balance. Now, this is a little different. We purchased supplies on account for $23,000. Supplies is an asset until we use them up. So what is one account that is affected when we purchase supplies on account? What that means is we purchase supplies, but we haven't paid for it yet. Okay? So our asset supplies goes up by $23,000. But since we owe the person money that we bought these supplies from, our liability also goes up, called accounts payable. When we owe money on account, we call it accounts payable. A note payable generally lasts over a year. So that's why it's a note payable. Okay? But do we still balance? Our assets now are at $323,000. Our liabilities are at $123,000, and our stockholders' equity is at $200,000. But we still balance, don't we? Right? Now, we're just going to bring it out a little more. Do you remember, guys, when I said retained earnings are those net income minus dividends paid throughout the beginning of time? You remember that? But what makes up net income? Revenues minus expenses equal net income. So we're just going to expand this equation a little. And under this section that's called retained earnings, revenues get added to retained earnings. Expenses reduce retained earnings. And dividends also reduce retained earnings, don't they? Does that make sense? Because ultimately net income goes into retained earnings, which is revenues minus expenses. Right? So, now with this expanded accounting equation, revenues increase our retained earnings, expenses decrease retained earnings, and dividends also decrease retained earnings. Retained earnings is one section of the stockholders' equity. Remember, stockholders' equity has common stock and our retained earnings. Okay? What happens?
You go back.
Of course. Whoops. Is that what y'all want? Okay. Now, here's an external transaction. We provide soccer training to customers for cash, $43,000. What is one account that's being affected? Cash goes up. And when we provide soccer training for cash, isn't that a revenue? It's why we're in business. Do you see that our retained earnings section under service revenue also increased by $43,000? So do you see now that our assets are $366,000? Our liabilities and our stockholders' equity are also $366,000? Does that make sense? Now, this is a little different. We provide soccer training to customers on account. What that means is they didn't give us cash. They owe us cash. So when we are due money, when the company is due money from a customer, that is called an account receivable. It is an asset because it is a resource. We are going to get cash eventually from that accounts receivable, aren't we? Does that make sense? Yes? So do you see, we provided soccer training to customers on account for $20,000. Accounts receivable goes up because we haven't gotten the cash yet, but we're going to receive the cash. And service revenue also goes up by $20,000. We provided the service, therefore we show it as revenue. Even though we didn't get the cash, we're going to get the cash. Okay? We received cash in advance for 12 soccer training sessions to be given in the future. Do you remember me telling you there is one liability that doesn't have the word payable after it? This is it. It's called deferred revenue. What that means, guys, is we're getting cash up front, but we haven't provided any services yet. So we owe them something. We don't owe them money. What do we owe them? Services, soccer training, don't we? Do you see how it is a liability? We have the cash, but we have not yet performed the service. This is the only liability that you're going to see that doesn't have the word payable. But don't get confused because it has the word revenue in it. It's not a revenue. It's called deferred revenue. Okay? It's not a revenue account. It's a liability account. We owe them services. Okay? Does that make sense? Do you see they gave us cash, so our cash increased. We didn't perform any services yet, so we don't increase our retained earnings. We increase a liability because we owe them something. Services. Does that make sense? But do we still balance? Don't let the account name fool you. Even though the term revenue appears in the account title for deferred revenue, this is not a revenue account. Deferred indicates the company has yet to provide services, even though it has collected the customer's cash. The company owes the customer a service, which is what creates the liability. Okay? Now, we pay salaries to employees. I want you to think about that. What happens when we pay salaries? What do we use to pay salaries? Cash. Cash goes down, doesn't it? But isn't salaries an expense, a cost of doing business? Right? Do you see that expenses reduce retained earnings? Remember, revenues increase retained earnings. Expenses reduce our retained earnings. Do we still balance though? We still balance. Now guys, we pay cash dividends of $4,000 to stockholders. We give stockholders dividends because, guys, they've invested money with us. They just don't do it for no benefit. Got it? If you're going to go and give someone $200,000, don't you want something? That money could make interest somewhere else. You want a benefit of giving someone money. So dividends reduce retained earnings, but remember, dividends are not an expense. It's a reduction in stockholders' equity. But we use cash to do it, don't we? Right? So our cash went down $4,000. Our retained earnings went down $4,000. Do we still balance? We do. We still balance. Our assets equal $360,000. Our liabilities and our stockholders' equity also equal $360,000. Students think that the payment of dividends to owners increases stockholders' equity. Remember, guys, we are doing the books for the company, okay? When the company pays out dividends, it's reducing our stockholders' equity. So now, all of these transactions we've analyzed. We've said, okay, what's one account that's been affected by this transaction? Did it go up or down? What's another account that was affected by this transaction, and did it go up or down? Okay, do you see how we were analyzing those transactions? And we end up having our assets equal $360,000. Our liabilities, we have 3 liabilities right now. We have accounts payable of $23,000. We have deferred revenue of $6,000. And we have notes payable of $100,000. So we have $129,000 of liabilities, and our stockholders' equity is $231,000. Do you see how our assets equal our liabilities plus our stockholders' equity? Yes? How y'all doing? Is it clicking? Kind of? What effect does the payment of dividends have on the accounting equation? What happens to cash? It decreases. Cash is an asset. Assets decrease, right? Dividends are part of stockholders' equity, aren't they? Right? And what happens when we pay out dividends? Doesn't our equity decrease too? So do you see our assets decrease and our equity decreases? Make sense? What effect does the payment Oh. Sorry. Now, this is going to be the biggest. Remember how last week I said the accounting equation was what? The biggest thing? Do you remember that? Assets equal liabilities plus stockholders' equity. This week, you're going to learn what a debit is and what a credit is. Guys, the biggest thing you're going to learn, do you see debit is on what side of this T account? Left. Credit is on what side?
Right.
What is a debit?
Left.
What is a credit?
Right. Right.
Don't forget it. Got it? If I say what is a debit, what are you going to say? Don't say increase. If I say what is a credit, you're going to say
Right.
don't say decrease. Debit just means, credit just means,
Right.
I might smack you if you get that one wrong. Here's why, guys. Certain things have a normal debit balance, and certain things have a normal credit balance. Remember our accounting equation? Assets are on what side of the equation? The left. Assets will have a normal debit balance, meaning when an asset increases, we're going to debit it, right? It increases by a debit. When we use cash, if an asset has a normal debit balance, then if we use cash, we'll credit it to reduce that debit balance. Got it? Liabilities, look at the accounting equation. Assets equal liabilities plus stockholders' equity. Assets are on the left side of the accounting equation. That means they have a normal debit balance. Liabilities and stockholders' equity are on the right-hand side of the equation. That means they have a normal credit balance, right? So assets increase with debits and they decrease with credits because their normal balance will always be a debit. Liabilities and stockholders' equity, since they're on the right-hand side of the accounting equation, will have a normal credit balance, which means they increase with a credit and they decrease with a debit. This, guys, use this as I hate to use the word cheat sheet because it's not. Write this down. Debits, assets go up with the debit, liabilities go down with the debit, equity goes down with the debit. And think about it. Expenses, if the stockholders' equity has a normal credit balance, expenses decrease our stockholders' equity. That's why they would have a normal debit balance. I would use this chart until it starts registering. Okay? Remember, all homework, all quizzes, all exams, you get to use your notes and your books, right? Use them. Okay? In the real world, you get to use notes and books. Thank God I don't have to memorize all the new accounting rules. My software makes me look way smarter than I am. Okay? Does that make sense? Okay, can I move on? So, assets have a normal debit balance, which means they increase with debits and they decrease with a credit. Liabilities and stockholders' equity have a normal credit balance, which means liabilities and stockholders' equity increase with a credit and decrease with a debit. Okay? So, as we do the expanded version here, we know dividends reduce stockholders' equity. So, dividends are going to have a normal debit balance. They decrease with a credit. Expenses also reduce stockholders' equity or retained earnings. So expenses increase with the debit, decrease with the credit. But revenues increase our stockholders' equity, don't they? So they increase with the credit, decrease with a debit. This is a great one. Dealer, DEA, dividends, expenses, and assets have normal debit balances. Liabilities, owner's equity or stockholders' equity, and revenues have normal credit balances. Okay? Dividends, expenses, and assets have a normal debit balance, which means they increase with the debit and they decrease with the credit. Liabilities, owner's equity or stockholders' equity, and revenues increase with a credit. Okay? What's a debit? What's a credit?
Right.
What does the word debit mean? Okay, now we're going to start recording transactions. We record transactions in what we call a journal. A journal is just a chronological record of all transactions by a company. The way we create a journal is we show the account name that gets debited. You will always have at least one debit and one credit. The account that gets debited, which means reported on the left-hand side, goes first. And then the account that gets reported on the credit side goes second, and it gets indented. Okay? So, on December 1st, when Eagle Soccer Academy sells shares of common stock to investors for cash of $200,000, what account is debited? Cash is debited because cash is a normal debit balance since it's an asset, isn't it? Since cash is increasing and cash is an asset, we debit it. What else is increasing? Common stock is increasing. But common stock is part of stockholders' equity. And to increase stockholders' equity is a normal credit balance. Do you see how that cheat sheet's going to help you right now? Students forget to indent the credit account names. For the account credited, make sure you indent both the account name and the amount. So, we're going to record all these transactions and then eventually post them to the various accounts. So what posting means is we'll take those transactions we're recording to the journal, and we'll transfer the debits and the credits to the accounts. Now guys, the good news is software will do this for you. But part of this class is so that you understand what's happening. Know the posting process is transferring the debit and credit information from the journal to each individual account in the general ledger. And the general ledger just houses all the accounts a company uses. The account title, the transaction date, the description, and columns for debit and credits are shown in the general ledger. So when we show this first transaction that cash increased by $200,000 and common stock increased by $200,000, to post this transaction, we will show this account called cash, which is an asset. We will show on December 1st, we issued common stock for cash and we debited cash for $200,000. So our new balance in cash here is $200,000. We also will take this account common stock, which is a stockholder's equity account, and we will show on December 1st, we issued common stock for cash and we credited common stock for $200,000. This is what posting is. It's just transferring those transactions to the individual accounts. On December 1st, when Eagle borrows cash from a bank for $100,000, do you remember? Cash increased because we borrowed money, but we owe it back. So our notes payable also increased. So the journal entry is debit cash, credit notes payable. To transfer or to post this transaction, we will take on December 2nd, it's December 1st, we will show borrowed cash, debit of $100,000. Do you see our new balance now in cash is $300,000? And then our note on December 1st, borrow cash by signing a note, we credit that $100,000. All we're doing here is posting that journal entry to the respective accounts they belong to. What we sometimes use in accounting is what we call T accounts. It's just an easier way of communicating what's going on. And you see cash, we debited those two sides, so we put it on the left. The notes payable, we credited, so we put it on the right. It's just another way of showing the various accounts. The left side of the T account is the debit column. The right side of the T account is the credit column. So this next transaction, on December 1st, when Eagle purchases equipment with cash for $120,000, equipment is an asset. Did equipment increase or decrease? It increased. So we debit it. Because it's an asset, assets to increase you debit. But our cash decreased, didn't it? We used cash. We decreased cash because we used it. Since cash is an asset and we used it, aren't we going to credit that because we have less cash than what we did? Make sense? Okay? On December 1st, Eagle pays 1 year of rent in advance, $60,000 a year, $5,000 per month. Prepaid rent is an asset. What happened to this asset? Did it increase or decrease? It increased, therefore we debited it. But what happened to cash? Didn't we use some cash? Do you see why it decreased? We credited it? Yes, no? Remember, guys, with every transaction, we're going to have a debit and we're going to have a credit. Okay? On December 6th,
So does that mean a transaction has never occurred when assets increase or that bit where we did our equipment or whatever in exchange for cash? So that's not a transaction.
yep, it's a transaction because cash decreased and equipment increased.
Even though it's the same stuff.
Even though they're both assets, we debited one and we credited the other. Okay? So they can be the same type of account, but it's always got to balance. If we debit one, we have to credit one. Okay? Now, on December 6th, Eagle purchases supplies on account. What does it mean when we purchase supplies on account? It means we haven't paid for it yet, have we? We owe them money. Supplies is an asset. We increased our asset supply, so we debit that $23,000. But we didn't use cash. We owe them money. So that liability called accounts payable got increased. We credit it. Make sense? On December 12th, Eagle provides soccer training to customers for cash, $43,000. What happened to cash? What happened to cash, guys? It increased. We upped it. Cash is an asset, which means we debit it. Service revenue is part of stockholders' equity. To increase a revenue or stockholders' equity, we credit it, right? So we credit service revenue. On December 17th, Eagle provides soccer training to customers on account for $20,000. So we didn't receive cash, but we're due the money. Don't they owe us the money? We're going to receive money from customers. Receiving money in the future is an asset. So accounts receivable goes up, and service revenue is a portion of common stock, and that's also going to go up, which means credit. Yes?
Couldn't they go bankrupt though? Then you wouldn't have any money.
Good point. So it's really important that companies make sure they get their receivables in time.
So isn't that due curiosity? The operating principle of assuming that business will continue.
Exactly. But you need money to continue. So like people can make good money, but if they're not getting it in, if they're making revenues, but if they're not getting paid on those services, it's not a good deal. I know for my company, and I can get by with it. Some companies can't get by with it, but I don't let a tax return leave the office until it's been paid for, because otherwise it's amazing how many people won't pay it. It's true. It's crazy. I mean, I don't leave the doctor without paying my copay and insurance gets billed. You don't go and get your hair cut. You get what I'm saying? You don't go buy groceries. It's just the way I do business, because it's unfortunate people just won't pay. Somehow they think they're doing it for free. I don't know. So, but what you're saying is a really good point. Down the road, we're going to talk about receivables and how quick they get paid. Companies need to find a way to get paid faster. Now, certain companies, it's just standard protocol that they give them 30 days to pay. And so if that's the standard protocol, people won't do it any other way. You get what I'm saying? So every business or every sector has their certain demands they have to adhere to. But you're exactly right. There are problems when they don't get paid. Because you can't stay in business, even though you're making money, if you're not getting the cash, you're not going to make it. Okay? I mean, how many of you guys have jobs? How would it be if your boss said, you know what, I'm sorry, we're just not getting the money in from the customer, so can we wait for another 6 months to pay you? Wouldn't you go like, you know, that wasn't on the recording, get it? No, thank you. So you got it. The only way you can pay your bills is to receive the money. Got it? I hope that didn't offend anyone. I'm sorry if I did. Okay, next. On December 23rd, Eagle receives cash in advance for 12 soccer training sessions to be given in the future for $6,000. Remember, what is this? What is that thing I told you is a liability but doesn't have the word payable after it? Deferred revenue. We owe something. We don't owe them. Well, if we don't pay the services, we owe them cash back, right? So cash increased, and our deferred revenue, which is a liability, also increased. On December 28th, Eagle pays salaries to employees for $28,000. Do you see that salaries expense has a normal debit balance? Why? Expenses reduce stockholders' equity. If stockholders' equity has a normal credit balanced increase, expenses are going to be a debit because they're decreasing stockholders' equity. Okay? And what happened to cash? It decreased, didn't it? So didn't we credit it? On December 30th, Eagle pays cash dividends to shareholders for $4,000. What happened to our cash? Decreased, we credit it. Dividends increase, we debit it. Guys, a lot of times what I do is I always think, okay, what happens to cash? If I know increasing cash is a debit, decreasing cash is a credit, and if I can figure out what I'm doing with cash, I can figure out the other. Because it's going to be the opposite. Okay? So here you see all of our journal entries from all of these transactions. The debit always goes first, and the credit always goes next. Okay? And then, by posting them to each account, do you see all of our transactions? Our cash, our accounts receivable, our supplies, our prepaid rent and equipment are all assets, aren't they? And if they're all assets, they all have a normal debit balance, right? Got it? And our liabilities you see here, we have accounts payable, deferred revenue, and notes payable. They all have a normal credit balance. So to increase them, we credit it. To decrease it, we debit it. Then our common stock and our retained earnings all have a normal credit balance. We know revenues increase our stockholders' equity, so that would have a normal credit balance. But our expenses and our dividends decrease our stockholders' equity. Therefore, we have a normal debit balance. Does that make sense? Which of the following is used to provide a chronological record of all transactions affecting the firm? The journal. Excellent. Which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? Excellent. Guys, this is what I do. When I pay $12,000 for 1 year of rent, of 1 year worth of rent, what's happening to my cash? It's going down, which means it's what? Credited. Therefore, prepaid rent has to be debited. And it's an asset, so increasing prepaid rent would be a debit. After we've done all of that, we then prepare a trial balance. Now, guys, a trial balance is only for internal use. All it shows is all the accounts and if they're debited or if they're credited. So, this is only internally, and all it's doing here, do you see it's a list of our assets? And do you see cash, accounts receivable, supplies, prepaid rent, and equipment are all assets, aren't they? And you see how they have to have debit balances. Then, do you see how our accounts payable, deferred revenue, and notes payable are what kind of accounts? Liabilities. And what do they have? Credit balances, don't they? Then, our common stock and retained earnings, we know stockholders' equity have to have credit balances. Then this last section, service revenue, is a credit because it increases stockholders' equity. Our dividends and our salaries expense is a debit because it reduces our stockholders' equity. The whole goal of this trial balance is to make sure our debits equal our credits. Do they? They better every time, right? Which of the following accounts would appear in the credit column of a trial balance? Excellent. Common stock is part of stockholders' equity. It has a credit balance. Prepaid rent is an asset. We know assets have a normal debit balance. Think of that dealer, D-E-A-L-O-R. Dividends, expenses, and assets all have a normal debit balance. Does that make sense? Yes? Below is a list of activities for Purple Cow Incorporated. For each activity, indicate the impact on the accounting equation. When we provide services to customers on account for $1,600, just think of one account that's being affected. When we provide services to customers on account, that means we didn't get cash. We're due the money. Accounts receivable goes up $1,600. What else is going to go up $1,600? Service revenue is going to go up $1,600, right? Do we balance? When we pay $400 for the current month's rent, so this isn't paying $4,000 up front. This is just paying rent as it comes due. This is a rent expense. Do we use cash or receive cash to do this? So we subtract an asset, $400, and doesn't our stockholders' equity go down $400? Okay, this is a trick question. We hire a new employee who will be paid $500 at the end of the month. Are we paying him $500 now? At the end of the month, nothing. This transaction is not an economic event. When I hire someone, great, they're going to work and then they get paid. But if I hired someone and said, I'm going to give you a $5,000 starting bonus, yes, it would be an economic event. Does that make sense? We pay $100 for advertising aired in the current period. What happens to our cash? Goes down. Subtract asset. And our advertising expense also goes down, right? Our expense increases, but our stockholders' equity goes down. We purchase office supplies for $400 cash. Think of this one. What happens? What happens to office supplies? They go up. What happens to cash? It goes down. You see there's no it stays the same. We receive $1,000 cash from customers in the activity above. Oh, this is the accounts receivable. Now they're paying us the $1,000. Okay? What happens to our cash? It goes up. our accounts receivable goes down because guess what? They don't owe us the money anymore. They just paid us. Okay? Make sense? When we obtain a loan from a bank for $7,000, what's one account that's being affected? What? Liabilities go up $7,000. And what else is going up? Cash is going up $7,000. Do you see you're always balancing, guys? Is it making sense? Now, here is a list of accounts. We're going to see what kind of account are they, and is it a normal debit or credit balance? I'm going to run to the restroom real quick, and I want you guys to think on this. You know I'm not going to call you out on it. Are they an asset? Are they dividends? Are they expenses? If we know they're those three things, what kind of balance are they going to have? Debit balance, right? If they are a payable, if they're common stock, if they're a liability, if they're common stock, or if they're revenues, they're going to have a normal what balance? Credit. Take a minute. I'll be right back, okay?
All parties are aware of how they, as long as it was appropriate. You care, don't you? It's up to you. State your case. That's your job to help you get it up. Just go ahead and achieve the results right now.
Of course, you take it.
Oh, what was it? His recruiting is to get everybody he needed students. He was persistent. So, that's nice, but it might be increased specifics. Like I know that ethics class has to go with it. It's going to be these requirements. So, it's decent amount.
So guys, salaries payable. What type of account is that? Liability. And liabilities always have a credit balance, right? Yes? Common stock. Stockholders' equity has a credit balance. Prepaid rent is what? Asset. Assets have a debit balance. Buildings, assets, debit balance. Utilities, expense, debit balance. Equipment, asset, debit balance. Rent, Expense. You see the drift? Expense is always an expense. Note payable, liability, credit balance, cash, asset, service, revenue, revenue. Okay? Does that make sense? Guys, honestly, this is the hardest chapter because you're incorporating so many pieces together right now. Okay? We've just spent time learning about the accounting equation. Assets equal liabilities plus stockholders' equity. We know the left side of the accounting equation, those accounts will have a normal debit balance because they're on the left. And the right side of the equation, liabilities and stockholders' equity, they will have a normal credit balance because they're on the right. Because debit means left and credit means
Right.
Then we started talking about all kinds of accounts. We're learning certain accounts are assets. Assets are resources that provide a benefit. Cash is a resource. Buildings. Accounts receivable is a resource because we're going to get money from that, aren't we? Supplies are a resource. Prepaid rent is a resource. Liabilities will always have the word payable except for one word, one account, deferred revenue. Okay? There's a lot we've learned. Hang in there with me, guys. Okay.